Hello everyone, this is Professor Kent, and as promised, I'm going to go through three questions. The first question is from chapter 13 and it's regarding asset retirement obligations. So it's from chapter 13 and it's regarding an asset retirement obligation. So asset retirement obligation. Now in this question we have to do two transaction at the time uh, to record the obligation and then adjusting entries at the end of the year. So in this question they said that Tin Mine International Limited discovered a new iron ore deposit, the Gruz mine, and began the production on January 1st, 2020. The province required mining corporation to return the land to its natural state at the end of the mining activity. Uh, Tin Mine International estimate that it will operate the mine for 20 years. So we have 20 years. What we're going to do it in 20 years? We have to bring the land back to normal. So it's an obligation for the future, but we needed to record it at the present. So on the first entry will be done on January 1st, 2020 to record the present value of this cost. So first we had to do it, we had to calculate the present value. How do we calculate it? Your future value is 25 million and your N will be, we're going to pay it in 20 pay in the year 25th. Your interest rate or your discount rate, not interest rate, your discount rate is your 8%. Your discount rate is your 8%. Your payment, we're not making any equal payments. We're going to make a lump sum payment at the end of the 5th year. Now then what we have to do is we have to compute our present value. When we compute our present value, the present value of this obligation is 3,650,448. So now what we have to record it, we have to record this amount today. By the time 25 years is gone by, the value of this obligation will be 25 million. That's what we have to pay, and that's the estimate. So debit will be an asset, the LB, what did we get is a Gruz mine, which is a debit, it's an asset. Credit is your asset retirement obligation, so it is asset retirement obligation. In this case we recorded at 3,650,448, 3,650,448. So that's will be your first entry. And the B part is this obligation, what we wanted this obligation. So this is the first year, that's when we got the asset, that's our retirement obligation. After the 25 years, your asset retirement obligation balance will be 25 million. At that time that we're going to make a payment. For each year, how this is going to arrive to the 25 million that we want in 5 years. Every year what you have to do is the carrying value of this obligation, we have a interest on that obligation. So how do we record the interest is different under the ASPE and under the IFRS. In this case, what the company is using an ASPE. If the company is using an ASPE, their debit entry will be different. The amount will be same, the debit account will be different. So I'm just going to show you both. If the company follows an ASPE, we are doing this entry on December 31st, 2020. Our debit will be your accretion expense, and credit will be your asset retirement obligation, and that will be the balance that we started off with and multiply by the discount rate. In this case it is 8%, and the value will be 2. The entry will be for something happened to my pen. So the entry will be, all you have to do is multiply by the the multiply by the rate. In this case, when you multiply by the rate, it's just gonna take time. My apologies. So all you have to do is take the 3,650,448, and then what we had to do is we needed to record the interest on it. And I hope my pen comes back. Yes, it did come back. So it will be 292,036. So that's the debit and the credit. Now, what if the company was following an IFRS? The only difference is it will be debit to the interest expense and credit will be same asset retirement obligation. The amount will be the same amount. So the amount doesn't change under the IFRS and ASPE. The only thing changes is the account name changes. One, we call it, if the company is following an ASPE standards, they will call it accruation expense. If the company is following an IFRS, they will call that an interest expense. Now the next question we had to do was, it's again, it's from the book, and I think it was 18